Good morning, everyone. Welcome back to Your Money Matters. Today, we've got the whole gang together. I'm Angela Giroux, the publisher of the Bauman Letter. Clint Lee is our research analyst. And of course, Ted Bauman is the editor of the Bauman Letter. So I always like to remind everyone, we record these on Friday, so there's no telling where the markets are as of Monday morning when this goes live. But we can say without a doubt, it has been an uncertain week. I think that's probably the best way to describe it. Stocks are up a little bit, they're down a little bit. The S&P and the Dow are not moving in lockstep with the NASDAQ. So we're just seeing a return of this volatility, a return of this uncertainty. Ted, obviously the COVID rising numbers are playing a role in this, but what else is going on?
Well, I think COVID is one thing, but it's something that I've been predicting really from the very beginning, which is that in July, when we started seeing actual data coming out from both corporate earnings and from the economy, from GDP figures and durable sales, all that kind of stuff, that people would begin to find it difficult to have just a kind of a sentiment-based approach to the market. I mean, essentially, people have said to themselves, the market's going to be great because the Fed is backstopping it. But there are limits to what the Fed can do, and we're about to find out what those are. And I think that what we're likely to see is that a lot of people who have been buying stocks based on this basically positive sentiment, which is good because some people have made money on it, they're going to find that they need to be very careful about when to sell, because as soon as we start getting real data on earnings, then it's going to be much harder to pick stocks. And that's what we do, and that's why we've been so focused on the idea of trying to identify companies that are going to get through this and not just, any old company that's rising in price. So I want to show two charts that actually illustrate what I'm talking about. The first one shows the analyst estimates for Q2 earnings for the S&P 500, and that's a pretty steep drop. I mean, that is a dramatic drop. And we've seen some companies in particular that they're kind of previews of earnings, and some of them are extremely, extremely dire, which is to be expected. But I think when people start seeing what those earnings actually are, then you're going to see selling pressure, and people are going to pile in to sell when that happens to try to get out of those positions while they still have profits. And on the right-hand side of that column, you can see why they'd want to do that, because the share prices have continued to go up. Next chart shows earnings estimates for a range of sectors, really only two of them in positive territory, healthcare and information technology, although I have my doubts about healthcare given the problems that hospitals have faced with the lack of optional services, which really generates most of their income. But everybody else are solidly down. The energy, financials, consumer discretionary, industrials, real estate, right across the board, down, down, down. So again, my take is that it's fine to ride the market up based on faith that the Fed is keeping it together, but we've been in an environment without information because nobody really knows what earnings are going to be. We're about to transition into an environment where we do know what earnings have been, and that's going to make people decide, well, I want this stock as opposed to that one. I want this one because it's doing well. This company didn't do well. And at that point, it's not about faith, it's about fundamentals, and it's about being able to pick what's going on. So that's my take.
All right. Well, Clint, let me ask you. We're now about midway through the year. It's been a crazy year. We know that. And Ted just brought up sectors. What do you see as being the sectors with the most opportunity heading into the second half of the year?
Yeah, so to Ted's point about how much of the rally up to this point has been driven by the Fed, by sentiment, by faith, so to speak, I think the key right now is to actually do the homework, do your research, and find out which sectors, which industries are seeing a durable recovery in demand. And you don't necessarily have to wait for 2Q earnings to start to roll in to see that. There's some hints out there already, and I'll walk through a couple sectors where we're seeing that. The first one is within home builders. Ted had actually talked about home builders during the depths of the decline as being a great value opportunity. Well, there's signs that that value opportunity is now becoming a growth opportunity, because we already had some good catalysts in place coming into 2020. One of them is demographics. The millennial generation is the largest generational demographic in the US with about 80 million people. And they are just now starting to hit sort of that peak age, that prime age of becoming a first-time home buyer. So you have that demand source there, coupled with what interest rates were doing. Now, coming into 2020, mortgage rates were already near record lows. Treasury yields were moving back toward record lows. And I'll show you a chart here. This is the average 30-year mortgage rate going back 5 years. You can see we had the steady decline in 2019, but then once the pandemic hit, with the flight to safety, with treasury yields, and with the trillions of dollars that the Fed's now purchasing of government bonds, that has pushed treasury yields to record lows, and you're now seeing mortgage rates following suit. The average 30-year rate right now is right about 3% based on this chart. But if you go out and do a search, you'll see offers out there for below 3% starting to come up. So those catalysts are in place. And one of the ways we can track how that's progressed so far, one of the things I'm following is lumber prices. I'll show you a chart here of lumber prices since the start of the year. Now, obviously, home builders are a key demand segment for lumber. And you see the plunge in prices during sort of the March-April period when, at the height of the lockdowns. And we had a slight recovery, but then in June and July, lumber prices have absolutely rocketed higher. That's because of all the pent-up demand, all the demand from the home building segment that we're seeing with that buying demographic, with mortgage rates now at record lows. And just to echo that sentiment, one of the home building stocks, one of the companies that we hold in our Alpha Stock Alert, actually came out this week and reported that June sales were its best month ever. They set a record. Sales were running at an annual pace of about 94% higher than last year. So once again, we're seeing several signs. We don't have to wait for earnings. We're already seeing several signs that home builders are seeing some big tailwinds. One other sector I would point out just real quick as well is with semiconductors. One of the semiconductor companies we follow closely is Taiwan Semiconductor. TSMC. They are the largest foundry in the world. Basically, that means they manufacture semiconductors. So somebody like an NVIDIA, they design the semiconductor, but then they outsource it to someone like TSMC to do the manufacturing. And one of the benefits in tracking that company is that they report monthly sales. And just this morning, they reported June sales were up about 41% compared to last year. I'll show you that in a chart right here. So we saw this decelerating trend in monthly sales, but now we're seeing this sharp uptick. And we've seen that confirmed with other companies as well. We hold a chip stock in the Alpha Stock Alert portfolio who came out yesterday, and it's rumored they sent a letter to their customers saying that they're seeing delayed delivery dates because of this big surge in demand that they're seeing from all end markets that we're seeing a pandemic tailwind like data centers, but then they're also seeing a recovery in end markets hit the most like automotive and industrial. So that's another area that you can play as well. For home builders, ITB is the ETF that we've recommended in the past, and that's a way you can get exposure there. And for semiconductors, the ticker is SMH for the semiconductor ETF.
Excellent.
Right. And as we look forward, one thing that we absolutely cannot ignore is the upcoming election, of course. Yeah. Ted, I know you have some ideas of how investors can get ahead of that.
Yeah. I mean, I've been talking and thinking about this from, sort of an investment perspective for some time now. And, my gut feeling is that no matter how it turns out, one of the things that the federal government is going to have to grapple with is that they need to continue to pump money into the economy, not just temporarily, but on an ongoing basis in order to sustain the level of economic activity in the face of COVID. And doing so through handouts, as you can see right now, is really difficult politically. But there's another way you can do it. It's less direct, but it could have a similar impact. And that is spend money on infrastructure. And I mentioned this in my video on Friday, where I said, that the stars are aligned for that. I think that there is enough of a push to get money into the economy without the political controversy involved, that I think both parties would probably agree to an infrastructure spending bill historically big next year. Now, it's a bit of a gamble, but I believe that that's going to happen. I would say that particularly under a Biden presidency, we would probably see a much greater chance of it. But even under a Trump presidency, I think it's just easier for them to agree to, right? I mean, we've got 40% of our national bridges are in disrepair. 20% of our highway miles are in disrepair, need to be replaced. We don't have a decent high-speed rail system, all kinds of things we could be spending money on, and that money would flow through the economy. But let's look at what the impact could be. And I want to start actually with a chart that shows one of the most bellwether stocks or prices there is, that's copper. Copper is one of the most important industrial stocks, but it's also critical to anything having to do with large-scale telecommunications, electrification, electrical vehicles, anything having to do with electricity basically is going to consume a lot of copper. And you know, look at the chart. I mean, basically, it is literally moving off the charts. The 50-day moving average for a common copper ETF is about to recross its 200, which is a very, very bullish sign. You don't normally see this happening unless people have a lot of faith in the future. And I think a lot of people are spotting the same opportunity I am, that we think there's going to be a lot of spending on things that will require copper. So, for example, there's you know, if you look at electrical vehicles, 5G, renewable power, it's all going to take copper. That's the kind of stuff that we could expect the US government and Asian and European governments to spend money on. So overall, I think that's a good indication that we're probably on the right track by thinking that government spending on infrastructure and things is going to be an important factor. But there are two other things to consider. One is gold, strangely enough. Typically, gold moves in the opposite direction. If the economy is looking very stable, getting better, people will shift away from it. But what we're seeing now is gold about to break out. I think it's been a consistently rising uptrend, as this chart shows. It shows that it, you know, aside from that little dip in March, it's really still rising quite strongly. So I think there's a play there. It's a much safer play than maybe some of the others, but it looks good to me right now. And gold miners in particular, some have gone up by 5-10% just in the last week. Some of the Canadians, some of the others have really gone up big time. And silver, the next chart shows that. I mean, silver is also going up very, very powerfully. The main silver ETF has crossed its, you know, had a positive cross 50, overtaking the 200-day simple moving average. And again, this is an industrial metal as well as an investment metal. And if we do see pickups in things like investment powered by government spending, then I think silver is going to be up there with copper, and then gold as your hedge. So there are some things you can be doing right now, I think, to position yourself for what's coming.
All right, great. Well, I think that about covers it for us today. As a reminder, we do, of course, invite you to join us at the Bauman Letter. There's a link at the top of the screen as well as below. If you're unsure, you just want to sort of dip your toe in the water and see what we have to offer. We do have a free e-letter as well. It's called Bauman Daily. We're offering that with a free report down below. And good luck, everyone. It's tough out there. Have a nice one.
Great. Have a good weekend, everyone.
Thank you.